Good morning and welcome to the Killik & Co podcast for Friday the 7th of November. This week we've had two rate decisions, one from the ECB, one from the Bank of England, both to keep rates on hold. The ECB have, however, committed to increase their balance sheet by €1 trillion euros back to the level it was in 2012, and they're ready to do more. So we see more unison amongst the policymakers in the ECB. Markets reacted well. This is the IBEX, which went up strongly on that press conference. And the euro continued to weaken, which is exactly what the ECB is looking to do. Here you can see it against the US dollar. We're now at a 2-year low, and that's continuing to put pressure on commodity prices. In the US, we had the midterms. The Republican victories meant that they've captured the Senate, and they've got a big majority in the House. So that's going to be more pro-business. So market reacted well to that. Good for the energy sector, good for the defence sector. So that was a positive. Today we've got the non-farm payroll, where we're expecting 235,000 new jobs for the month, and the unemployment rate to be 5.9%. The sort of key number here is 5.4, which is the Fed's natural rate of unemployment. At that point, they would probably start to consider raising rates. So we'll probably get that to that level of unemployment in mid-2015 if we continue to have this monthly addition of around 250,000 jobs. So the US market's been very resilient. Part of that has been the resumption of buybacks from companies post the Q3 results. So here we can see a chart of the 100 companies in the S&P who've got the biggest proportion of or buyback ratio. And as you can see, you've seen a big outperformance of those companies against the overall market. This raises questions about what companies and management teams are doing with their available cash. And at the moment, they're not really investing it in further capex. So the companies that have been outperforming have been the buyback companies. But capex utilization is now approaching a level where these businesses are going to have to think about building that next factory if aggregate demand is going to continue to increase. So we're watching the forward-looking data in this space quite carefully, and here you can see the expected pickup in capex in survey data, which is still pretty minuscule. So how are we playing this sort of area? At the moment, we're playing it through technology companies because that is, in our view, the first early stage of capex before you go and do the big build-outs. We are doing a little bit more work in the network space within the telecom sector, but we still think it's fairly early days in this area. Here you can see the benefit of that increased use of technology within business, and we are seeing a continued rise in the productivity rates of employees. And again, this week we saw an interesting number where productivity rose 2% in the last quarter. This week we've got Vodafone reporting. Next week we've got Vodafone reporting. So I think it's worth just having a quick look at Vodafone. This is a chart of Vodafone against Verizon. And as you can see more recently, Verizon has outperformed Vodafone quite markedly. That difference here, we feel, is the difference in being able to transmit more data. Now, data is something that is higher margin for telecom providers. And it's something that you need better networks to be able to provide. So in the US, we've had an evolution to LTE, long-term evolution, or 4G networks. And Verizon currently runs around 60% of their mobile customers on these higher speed networks. Vodafone at the moment is on 5%. So we can see over the next few years, great possibility for Vodafone to increase that level. And we saw when Verizon moved their customers onto the LTE network, their revenues increased by 7% per annum. So that's a great opportunity for Vodafone. As you can see here, on 4G rather than 3G, users consume 3.5 times more data. Cisco's got a number in terms of acceleration of data volumes that are used of around 61% per annum through to 2018. So you can see it's a very big market opportunity. And we feel Vodafone, with a 5.5% yield on an EV to EBITDA ratio of 6.5, is not really pricing that in adequately at the moment. So other stocks for next week, we've got on Tuesday we've got Vodafone, we've also got Land Securities. Wednesday we've got Burberry, we've got Sainsbury's. It's going to be very interesting. We had better results from Morrison this week. We've got Rolls-Royce on Thursday. They pre-announced, so we shouldn't expect too many surprises there. Just on the macro, we've got Chinese inflation data on Monday. Probably the big one for us is the Bank of England inflation report that's coming through on Wednesday. And then we got some retail sales on Friday in the US. So just to leave you, the big stock this week has probably been Marks and Spencer's. So it was up 16% over the last 2 days. So why is this? We've got big upgrades coming through from the investment banks. UBS referring to Marks and Spencer's as the next. Why are they saying this? Well, Marks and Spencer's traditionally their margins have been extremely poor. So over the last 8 years, Next Retail's gross margins have increased by 9%, while M&S has fallen. Currently, the M&S operating margins are at 6.1% against Next at just short of 20%, which is a huge differential for very similar businesses. It's even worse in the general merchandising division, where M&S are at 2%, and you've got Primark at 12%, Gap at 13%, Inditex at 19%. So there's huge scope for M&S to increase their margins and make a material difference to what is a very big sales number if you're enhancing that margin number. So in their interims, their half years, they guided to a 200 basis point increase in that general merchandise gross margin. So if that's the start of a better trend, then that would be a very strong driver for the M&S shares. So that's it from me. Have a good weekend. Thanks very much.